Hello, everybody, and thank you for joining us today for our presentation, The Long Road Ahead, Offshore Drilling in an Age of Transition. My name is Matthew Donovan. I'm Senior Rig Analyst at Esgian. And to give the presentation today, we'll be joined by Senior Rig Analyst Sofia Forestieri and Sustainability Lead Ajay Rahel from our Energy and Emissions team. And in their presentation today, they will discuss how the IEA and OPEC's world market views will affect rig supply, demand forecasts, and rig valuations during the energy transition. So thank you all for joining us. Our session today will run around 30 minutes, including around 5 minutes at the end for a Q&A period. So I will now hand over the presentation to Sofia Forestieri. Thank you all for attending.
Thank you, Matt. Hello, everyone. Good afternoon. So today our presentation will be, it's called The Long Road Ahead, Offshore Drilling in an Age of Transition. And now I'll go through the agenda with you. This presentation is divided into three main parts. We start with an introduction, where we talk about how the future oil demand is all about perspectives. We have the two biggest entities in the energy sector, IEA and OPEC, and they present completely different views of oil demand, and it's like living in two different worlds. Also, on those views, they clearly present us the destination, the points in time, not the journey. Then we go about analyzing the most extreme IEA and OPEC scenarios and why for us at Esgian they are unlikely to happen. We follow that by analyzing the IEA APS scenario, which is heavily dependent on the switch from ICE cars, internal combustion engines, to EVs, electrical vehicles, and how also for us this scenario is unlikely to happen. Then we get to where we stand, and we call that the intersection where IEA and OPEC meet, and there that is the IEA STEP scenario and the OPEC advanced technology scenario. Then we get to the most important question of the day, which is, what does this mean for the offshore drilling industry? We conduct two exercises there. We talk about rig supply in a new world, so no new builds. Does that mean more reactivations? We also go into the what we call the golden sunset, offshore drilling thriving in the energy transition, and that is rig demand forecast. And finally, rig values in the energy transition. Will be the energy transition the third whammy in the offshore drilling sector? Will we see higher day rates? Will we see higher rig values? To kickstart today's presentation, then I hand it over to my colleague Ajay.
Thank you, Sofia. Okay, as Sofia mentioned, we'll start the presentation by being a bit kind of philosophical, and we ask whether the glass that you see on the screen, whether it's half full or if it's half empty. I guess there is no straight answer to that. The answer depends on your perspective, your perception of your environments, the glass, how you interpret the situation, etc., etc. And it's such kind of different perspectives that I'll focus on over the next 10-15 minutes because they are crucial to understand and determine the future oil demand, or perhaps even more precisely, your understanding of the future oil demand. And keeping perspective in mind. So as Sofia mentioned, IEA and OPEC are some of the most important voices in the energy industry, and their oil demand outlooks are perhaps some of the most applied oil demand forecasts in the oil and gas sector. And then therefore it's very interesting and almost a bit striking how diverging IEA and OPEC's perspectives are when it comes to the future of the fossil industry. So if we look at the 2050 demand outlook and the key assumptions behind this outlook from IEA and OPEC. So IEA is saying that they foresee or they expect an economic slowdown over the next decades predominantly because China will not be able to keep the economic growth that is shown over the past 10-15 years also in the future, so that the growth from China will slow down. But then you have OPEC, and their key assumption for their 2050 oil demand outlook is that the economic growth will continue to be strong. The only difference is that most of the economic growth is going to move from OECD countries to non-OECD countries. So you see already on that one key assumption on economic growth, they are completely different. And then you have on the deployment of renewable energies. So IEA is assuming that, or what they call a fossil sunset, that renewable energy will increasingly take this place from fossil fuels in the power mix, and especially from coal, but also from gas. And then if you look at OPEC, on the other hand, they're saying that there will be energy policies in place, but they are not necessarily going to be that successful. So for instance, the switch from ICE cars to EVs won't necessarily be realized, or at least not to the extent that the plans are at the moment. And then also on renewable energy, so IEA's also key assumption is that there will be a general electrification of the society, which will be driven by renewable energy predominantly. But then OPEC, on the other hand, is saying that yes, there will be an increased energy demand, but it will be driven by three things. So it's energy security. It'll be driven by new technologies such as AI that will require large amounts of energy, and by population growth that will require all sources of energy because demand goes up, or energy demand goes up. So OPEC's argument is that renewable energy will not be able to, or the argument is that there in the future there will be place both for fossil energy and also for renewable energy. So as you can see that the key assumptions behind their outlook is very, very different. And IEA's and OPEC's assumptions then materialize into different scenarios. So both organizations have three different scenarios, and kind of call it the high case. The scenarios where they predict the highest oil demand is IEA's STEPS scenario and OPEC's laissez-faire scenario. And then you have kind of call it the mid-level, mid-range scenario, which is IEA's announced pledges scenario, or APS, and you have the OPEC's reference case. And the low case scenario is IEA's net zero emissions by 2050 and OPEC's advanced technology. So what's perhaps the most striking when it comes to these scenarios, in my opinion at least, is that in the IEA scenarios, you don't have a single scenario that shows an increase in oil demand over the next 10, 15, 20 years. It's all either that the oil demand is going to remain flat or that it's going to fall. But then on the OPEC side, none of the OPEC scenarios are showing a decline in oil demand. So either the oil demand will remain flat under the advanced technology scenario, or it will increase. So again, going back to what we started off with perspective. So whether you see an oil demand outlook from IEA or OPEC, it depends on what you believe in. And also, I think perhaps the key takeaway is that when you see one of these outlooks, it's important to know what the key assumptions behind these outlooks are, because they can be extremely different. Another thing that I would like to highlight, and I think is very important to keep in mind, is that neither IEA or OPEC provide kind of an entire time series on how long-term oil demand will develop. So instead, what they do is that they give you the demand outlook in 2030, and then OPEC will give the demand outlook for 2045, and IEA does the same for 2050. But what happens between 2023 and 2030 is not given. What happens between 2030 and 2045 is unknown. And so is the case what happens between 2030 and 2050 on the IEA oil demand outlook. And I guess so, kind of to understand how the oil demand will develop in the periods or time frames that are unknown, I guess the human brain has a tendency to simplify, and the easiest way or the simplest way to connect two dots is to draw a straight line in between them, so that you get a kind of a linear development, whether a growth or a decline between 2023 and 2030, and 2030 to 2045 or 2050. But if we look at historical oil demand, we know that the development is not necessarily a linear trend. So most likely oil demand will follow a more kind of curve development that doesn't follow an annual growth or a decline that's based on a constant. So instead of trend lines like this, it's probably going to be more like this, where we see a slow decline in the near term and a more steep decline in oil demand in the longer term, as low carbon, no carbon technologies mature and commercializes, and also they see more kind of a market penetration. But that was kind of more on in general terms. So if we have a closer look at the different scenarios and analyze the relevance or the likelihood of them becoming a reality, and we'll start off with the most extreme scenarios and describe why we think they're unlikely to become reality. So if we start with OPEC's laissez-faire and reference case scenarios. So these scenarios assume that things are going to be more or less business as usual, and there will be not no effort, but at least quite limited effort to reduce emissions and global warming. But if one keeps in mind that the STEPS scenario, IEA's STEPS scenario, assumes a 2.4 degree global warming potential. So with the OPEC laissez-faire and reference case oil demand at the levels that we show here, which is, by the way, for assuming a 30% share from offshore oil and gas, that would equal what? 3 degrees warming, 3.5, 4 degree warming. And kind of given the political pressure, policy developments, and also technological developments, low carbon, no carbon technologies, we don't believe that this type or kind of global warming at that level will be acceptable among decision makers and policy makers. So we don't think that these two scenarios will be the ones in the future. So basically that the oil demand will follow these two scenarios. And then you have IEA's most extreme scenario, which is the net zero scenario. I won't spend too much time on that because leading climate scientists have kind of confirmed, or they say that our carbon budget has almost been exhausted already to reach the 1.5 degree target under the Paris Agreement, and that there is a consensus that this target is very difficult to reach. And because of this kind of the scientific approach, or kind of the knowledge that we have that the 1.5 degree target is far-fetched, we don't think that the oil demand in the future will follow a trajectory that aligns with that 1.5 degree scenario. And then you have the IEA APS scenario. And this scenario is a bit interesting, and there's a reason why we have kind of we show this on a whole slide. So what you see on this slide is the APS scenario. It's broken down, or oil demand in the APS scenario broken down by sector, so to be more precise. And what you see is that road transportation is the by far most important oil demand driver in this scenario as well. followed by industry sectors. So first of all, if we keep in mind what we talked about, kind of that is the development is most likely not going to be a straight line, but perhaps more likely to be something like this. And secondly, the reason why we are questioning the APS scenario is that this scenario is heavily leaning on a successful decarbonization of the road transportation sector, which makes this sector very vulnerable to a successful deployment of EV cars at the expense of ICE cars globally. And if you look at kind of the political headwinds and the geopolitical tensions that are arising, and also that the EV industry is likely to face in the near future, we see numerous obstacles that lie ahead for this scenario. And that is, for instance, the EU-China trade war on EVs that has started. There is the politicization of US climate policy, which will have an impact, or can have an impact, following the presidential election later this year. There was the EU Parliament elections a week ago, 10 days ago, where you saw that the Parliament is moving further toward right, and there was a larger grouping, or there are groups that are coming to power that don't necessarily propose or support the Green Deal. And especially the ban on petrol and diesel cars from 2035, that this policy might be up for grabs in the next couple of years. So there are some roadblocks ahead for the transition from EV cars to ICE cars. And then just one other thing that I would like to highlight in this scenario is, if you notice on the chart here, is that the oil demand from other sectors is actually relatively stable going all the way to 2050. So when it comes to the IEA APS scenario, because of the overly high reliance on EVs and the political headwinds that we think that the EV industry will, or EV sector will face going forwards, we think that the APS outlook will miss both in terms of the oil demand in 2030 and 2050, and also on the pathway towards 2030 and 2050. And that brings us lastly to the IEA STEPS scenario and OPEC's advanced technologies scenarios. So both scenarios, they recognize that it takes time to commercially deploy and scale up low carbon technologies. They say that it will happen, but it will take time and it's not done overnight. And there are primarily two reasons why it won't be done overnight. And firstly, is because low carbon technologies need to reach a technological readiness level that includes, or that allows for both scalability and also low risk. And we're not necessarily there for the key technologies such as hydrogen and CCS. It will take time. And secondly, it's that there is already, with the kind of the existing technologies and solutions, whether that's ICE cars or if it's the shipping industry or aviation industry, there is so much stickiness in the current technologies and in the current fleets that it will take time to replace, say, the car fleet from fossil engines or ICE cars to EVs. Can take kind of decades to make that transition. And the two scenarios also take into consideration the fact that global scale electrification will require enormous amounts of energy. And that will take time, or that it will take time before renewable energy deployment is so high that it both replaces fossil fuels and also meets additional energy demand that is arising from the electrification of the society. So it's this kind of gradual phase-in of fossil fuel replacement and new technologies that make us believe that these two scenarios are the most likely outlooks for future oil demand. And if we are right, if these become the pathway for future oil demand, of course, they will have a significant impact on the offshore drilling industry, which now Sophia will be discussing next. So over to you again, Sophia.
Thank you, Ajay. Yes, so now that Ajay has set the scene, we go back to, as I mentioned before, the big question of the day: what does this mean for the offshore drilling industry? Next slide, please. So we conducted 2 exercises to analyze the situation. We start here with rig supply forecast. So we have competitive rig supply in a new world. For the first time in 50 years, we're assuming no new builds. What does that mean? Are we going to see more reactivations? Looking at this chart, I will walk you through our steps and assumptions to create this scenario. We start with total rig supply at 703 rigs. Out of those, we are considering 152 rigs as being uncompetitive. I will shortly explain what is uncompetitive for us. Also, we have 30 rigs that are under construction. Out of those 30 rigs, we're assuming that 10 would still be delivered this year. And also that most likely 10 would be scrapped. And that leads us to a competitive rig supply of 521 rigs in 2024. And that's what we see in the first bar of the chart. Now, when it comes to our assumptions, what are uncompetitive rigs for us? Those are long-term cold-stacked rigs, stranded assets in shipyards, operator-owned rigs, and sanctioned assets. Another assumption, as mentioned already, no new builds are being expected. When it comes to the deliveries, we are assuming that floater deliveries will all happen by 2030. And the most deliveries for jackups would also happen by 2030. When it comes to attrition, we're assuming a slowdown after 2030. And we're also assuming that stacked rigs, they will most likely be reactivated rather than scrapped to meet this new demand. And that upgrades and life cycle extensions are more likely to happen rather than being recycled. One point that is very interesting to point out, Ajay, can you go back to the previous slide real quick? Yes, is when we look at this competitive rig supply of 521 rigs, the last time that the market has seen such competitive supply was in 2003. That is basically 20 years ago. So it's very interesting to see that today, that is the number that that we have, and that is the number that we're kickstarting the forecast, and that led us to the next slide, which is our rig demand forecast. So here, what we see is what we like to call the golden sunset, how offshore drilling will thrive in the energy transition. On this exercise, on the chart, you see the same competitive supply, and we are now going to analyze rig demand in where Esgian stands, which is IEA steps and OPEC advanced technology. I will also walk you through the steps and assumptions that led us to the results on this exercise. So as Ajay mentioned on his presentation, we're assuming 30% offshore production, also 6% depletion, and new barrels being needed to offset set depletion. Also an average 6 year from drilling to first oil. Drilling efficiency being the historical rig count in relation to historical added new barrels. And what has that gotten us? It has gotten us to the 2 green curves that you see here on the left, which is a healthy demand for rigs in the next 15 to 20 years. Now, how is utilization going to look like in this new demand scenario? We will see in the next slide. And what we have here is that rig utilization could go as high as 90%, and that means a tight market. And what is utilization? It is rig demand in relation to the competitive supply we have just seen. And when we see such a tight market, such high utilization, what does that mean for day rates and rig values? Next slide. Yes, so here we start looking here at today's Esgian's day rate forecast. This day rate forecast accounts for already the risk of the energy transition by 2026. That's why we see the decline in day rates. But assuming this golden sunset view, we have the curves in green, which are the new forecasts for day rates. So this perspective extends the market life cycle to 2030 and beyond. And we see that the high utilization is leading to those higher day rates go again by the end of the decade and even longer. 7th-generation drill ships can see day rates close to $600,000. That is matching the pre-downturn levels. And we have already seen jackups now today being fixed around 150,000, 200,000. And that's despite Aramco's suspension. So we could see values going even higher for those rigs as well. What does that mean? How does that impact rig values? We'll see in the next slide. Here, before we get to the result, we're just going to have a quick look in the past, in the historical behavior of rig values. So our market is a market that is used to crashing and recovering, as we can clearly see on this chart. So since the downturn, drilling values, they have been hit by what we call a double whammy. So we had shale growth and OPEC's oil price loss. We had a fragile recovery starting, as we can see from the chart, in 2018 that was hit by COVID in 2019, which crashed the oil price by negative $37. Then we had the post-pandemic times where debt holders became shareholders. We also saw leadership now. We also see leadership now emphasizing financial discipline given those fluctuations. And given all of this scenario, when we look at the energy transition, we don't see it as being the imminent third blow or the imminent third whammy. Then again, what does that mean, or where can rig values go from here? This is what we see here in this next slide. So we're seeing offshore drilling experiencing a stable market growth without excessive supply expansion, as we saw previously on the supply forecast slide. And what we see here for rig values behavior is that they're likely to stay high or rise due to this new view, which is higher for longer, and also due to the fact that we're expecting fewer new rigs. The golden sunset outlook suggests rig values could match peaks of past markets by 2035. Next slide, please. And on this last slide, what we are seeing here is that this potentially higher for longer view that we have on the golden sunset scenario supports even higher multiples and values than the ones that we're expressing here in this table. So we see, for example, for premium jackups in 2010, 2014, that they had multiples around 5, even higher than 6. And for drill ships on the table below, for the same years, higher than 4.5. And when we look again into the future, in 2025, 30, 35, we believe that this with higher rates, higher day rates, higher earnings, and possible even higher values, we're still seeing fair multiples, 3.2, 2.7, 3.7, 4.2. What does that mean? We believe that in the golden sunset scenario, multiples could be even higher. So, and also when we look in the chart to the right, where we're comparing implicit values from Pareto versus Esgian rig values, which of course also include the latest transaction, Diamond and Noble. We believe that the golden sunset scenario here, which again extends the life of the market, gives more room to breathe, could also mean that those implicit values could be higher. So the multiples would have room to be higher, to grow, because you don't have this urgency that the market will see an imminent downturn, and the same for implicit values. With that, we go to the next slide, which is where here we get the key takeaways from this strong message, and we start by saying that supply discipline. With supply discipline, that is a very important thing. The offshore drilling industry can thrive through the energy transition. This view, this golden sunset view, is a realistic perspective for development and time of new green alternatives. They are going to be deployed, they're coming, and we're assuming that. We also believe the rigs could remain high earners and attractive investment investment opportunities for years to come. They may reprice, and so will public drillers. Very important as well. The energy transition is here to stay, no matter what. So, but it's going to be a slow evolution, and that will lead to our higher for longer golden sunset scenario, which is an extension of the life of the offshore drilling market. Based on this golden sunset perspective, we believe that this third whammy is a smaller threat, and on the contrary, it could offer long-term opportunities for us in the industry, but also, given this room to breathe and for more opportunities, we believe and we emphasize that responsible operations and investments with a concern for the climate in the energy transition are very important. They are what we like to call the license to operate. And this is what we also call today the long last dance. Thank you very much. Now we open the floor for Q&A, I guess.
Thank you. Yes, thank you very much, Sophia. Thank you, Ajay. So we'll have a quick moment for some Q&A questions. We are a little short on time, so if we don't get to your question during this, we will send out an email response to that otherwise. So just a quick question here, Sophia. In the scenario you present, why are you assuming that attrition slows down after 2030 in that rig supply forecast?
Yes, Matt. Okay, attrition slowing down by 2030.
Yeah.
We're assuming that for given a few reasons. So first one, the demand with no new builds entering the market, as well as that the most obvious targets for attrition, which are long-term cold stack rigs or uncompetitive rigs, they would be most likely scrapped, not reactivated. And that's all to avoid companies draining their resources. Also, as we've seen during the presentation, the newer rigs in the current fleet, they would be most likely upgraded or have life cycle extensions rather than being scrapped as well. So that's why we're assuming this slowdown post this decade.
Right. All right. Thank you very much, Sophia. As I said, we're running a little short on time, so we will address other questions via email. But thank you again to Ajay and Sophia for the presentation today, and thank you everybody for attending this Esgian presentation. I believe we'll be making copies of these slides available for attendees at some point later. So once again, thank you all for attending. Much appreciated.